Hello everyone, welcome to Global Online. In today's lecture, we are going to see NTA UGC NET Paper 2 Commerce 2022 batch, and this is a lecture 4 of unit number 10, that is income tax. In today's lecture, we are going to see income from the house property and capital gain. This is again the important topic under this unit because you will be definitely receiving questions from this topic. So do watch this lecture to clear your all the doubt related to this topic. Before we start with the lecture, I want to tell you that we the Global Online providing the course for the paper 1 in which we are providing you the daily life lecture, notes on all the topic, last 10-year question papers with a detailed explanation, test series covering 2500 MCQ with the detailed explanation. To get this, download our app Global Online or WhatsApp on this number. Okay, and the fees for this is 3500 rupees only. Students, we are also providing course for the UGC NET Commerce Paper 2, for which you have to download our app, that is Global Online, from your Play Store. Once you download the app, you have to register your number and go in the store and search for the UGC NET Commerce Paper 2. In this course, you are getting the complete video lectures on all the unit, notes on all the unit, test series, plus the previous year question papers with a detailed explanation and target based preparation. And if you are taking this course, the paper 1 you will get the free of cost. No need to buy the paper 1 separately. Okay, and the cost of this course is 7000 rupees only. Ownership of the house property. Now what is the ownership of the house property? The word ownership here is the owner. Okay, we are talking about the owner of that house property. It is only the owner or a deemed owner of a house property who is liable to pay the tax on an income under this head. So, while filing the income tax return, there is a one head, that income from the house property. The owner of that particular house property who is liable to pay tax will be coming here. Okay. The owner may be an individual, the firm, the company, cooperative society, or an association of the person. The owner may be anyone who is own the house property. It may be the individual, the common person, maybe the firm, maybe the company, or maybe the cooperative society or association of the person. The property may be let out to a third party either for the residential purpose or for the business purpose. Annual value of a property is assessed to the tax in the hand of a owner even if he is not in a receipt of the income. Supposing one person is having a house property, supposing I am having my house property and that house property I am giving to the third person as a let out, okay, for his residential purpose or maybe for the business purpose. Maybe the third person might doing any business in that particular house, but ultimately I am the owner of that house. So here I am liable to pay tax on my house property and not the person who is using that house. Okay, for the tax purpose the assessee is required to be owner in the previous year only. Okay, so here if I am going to pay the tax on my house property, that means I will be the owner of that house property in the previous year. That time only I will be able to, or I will be liable to pay the tax on the house property. House property income is exempt from the tax to the certain persons. Okay. Here we are talking about the exemption under the house property income. For this, the first person is, or a first condition is, an ex-ruler of his occupation. Then is local authority. Third one is approved scientific research association. Then is institution for the development of khadi and village industry. Then is khadi and a village industry board. Sixth one is the body or authority for administrating the religious or a charitable trust or endowments. 7.1 is certain fund, educational institute, hospital, etc. 8.1 is registered trade union. 9.1 is statutory corporation or a institution of the association financed by a government for promoting the interests of a member of SC or ST. 10th one is cooperative society for promoting the interests of the member of a SC and ST. 11th one is charitable trust, and 12th one is political parties. So all these are exempt from the tax. They don't have to pay the tax on the house property. Then is determination of annual value. The basic of calculating the income from the house property is the annual value. Okay. While calculating the income from the house property, the basic is the annual value. This is a inherent capacity of the property to earn the income, and it has been defined as the amount for which the property may reasonably be accepted to let out from the year to year. Let out means giving for the rent. It is not necessary the property should be actually let out. The municipal value of the property, the cost of construction, the standard rent, if any, under the Rent Control Act, the rent is a similar property in the same locality, are all the pointer to the determination of the annual value. Then is gross annual value. Now here understand what is gross annual value. The gross annual value is a municipal value, the actual rent, whether the receive or a receivable, or the fair rental value, whichever is the highest. Okay. Here we will considering the municipal value, actual rent, and a fair rental value. And from this, whichever is the highest will be considered as a gross annual value. Okay. If, however, the Rent Control Act apply to the property, the gross annual value, fair rental value, or a municipal value, whichever is a higher, or a standard rental value, whichever is less. If supposing here the Rent Control Act is applied to the house property, that time the fair rental value or a municipal value from this whichever is a higher will be considered, or the standard rental value whichever is less is a consider. If the property is a let out but remain the vacant during the part or a whole of the year, due to such a vacancy, the rent received is a less than the reasonable accepted rent. Such a lesser amount shall be the annual value. If supposing the house property is let out but it remained vacant during the whole year, or supposing for the 6 month there was something or there is something people are living, or during the another 6 month it was vacant. So during such a vacancy the rent received is a less than the reasonable accepted rent, and such a lesser amount that time will be treated as a annual value. The principle of determining the JAV, that is gross annual value. How we are going to determine the JAV? So here the accepted rental value or actual rent received for a whole year, whichever is a more, will be considered. Here we are looking for we are comparing the accepted rental value with the actual rent received, and from that whichever will be the more will be considered. Here accepted rental value is calculated as a follow. If the latter house property is subject to the Rent Control Act. If supposing here we are considering the Rent Control Act, that time the accepted rental value will be the fair rental value or a municipal rental value, whichever is a higher will be the consider. Okay. And if the latter house property is subject to the Rent Control Act, that time the accepted rental value is fair rent value or a municipal rent value, whichever is a higher. That we will compare first, and from that we will compared with the standard rent value, and from this whichever is the less will be the consider. Municipal tax include the service tax like a water tax, sewerage tax levied by any local authority. It can be claimed as a deduction from the gross annual value of the property. Here are the some conditions. First one is paid by the owner. The tax shall be borne by the owner and tithe same was paid by him during the previous year. So here we are talking about the ownership of the house property. Second point is property let out. Municipal tax can be claimed as a deduction only in respect of the let out or a deemed to be let out property, that is more than one property of a self-occupied. Whenever we are giving the house property for a let out, that time we are talking about this condition. Okay. Third one is year of payment. Municipal tax relating to the earlier previous year but paid during the current previous year can be claimed as a deduction only in the year of the payment. Fourth one is advance taxes. Advance municipal tax paid shall not be allowed as a deduction in the year of the payment but can be claimed in the year in which it falls due. And last point is borne by the tenant. Municipal tax made by the tenant are not allowed as a deduction here. So these are some conditions which you have to remember while calculating the tax under the house property. Then is unrealized rent. Now this unrealized rent coming under the rule 40. Please remember this rule, that is 40. Unrealized rent means the rent not paid by the tenant to the owner, and the same shall be deducted from the annual rent receivable from the property before computing the income from that property, provided the following conditions are satisfied. Unrealized rent here means the any amount of the rent which is not paid by the tenant to the owner of the house property, and that amount shall be deducted from the annual rent receivable from the property before we compute the income from that house property. Okay. So again here there are some conditions which we have to satisfy. The first one is the tendency is bona fide. Second one is defaulting tenant should have a vacant property. Third one is the assessor has taken a step to compel the defaulting tenant to vacant the property. Fourth one is the defaulting tenant is not in occupation of any other property owned by the assessee. Okay. And the fifth point is the assessee has taken all the reasonable steps for recovery of unrealized rent or satisfy the assessing the officer that such a step will be useless. Okay. Here the owner have to try to take that rent from the tenant. Okay. And such a proof have to be shown. Then is income from the self-occupied house property. The annual value of one self-occupied house property is taken as nil. From the annual value, only the interest on the borrowed capital is allowed as a deduction under section 24. The amount of a deduction will be either the actual amount occurred or rupees 30,000, whichever is less. Here we are considering the less amount. Okay. When borrower of a money or a acquisition of the property is after the 31st/3/1999, deduction is rupees 2 lakh. Okay. Here under this, the self-occupied house property, the house which I am using for myself, that time the amount will be taken as nil. However, if the borrower is for the repair, renewal or a reconstruction, the deduction is restricted to the 30,000. If the borrower is for the construction acquisition, higher deduction is noted as above is available. If a person owns more than the one house property, using all of them for a self-occupation, he is entitled to exercise an option in terms of which the annual value of one house property as will be specified for him will be taken as a nil. Then is capital gain. Again, the important concept under the income tax is the capital gain. So here when we are talking about a capital gain, the profit or a gain arising from the transfer of the capital asset made in the previous year is taxable as a capital gain under the head capital gain. Okay. Whatever profit we are receiving after we transfer the capital asset during the previous year, which will be taxable. So where it will be taxable? It will be taxable under the head capital gain in the income tax return. The capital gain is chargeable to the income tax if the following conditions are satisfied. So here again there are some conditions which the assessee have to satisfy. The first one is there is a capital asset. Okay. The whatever he is transferring, it should be a capital asset. Second one is assessee should transfer the capital asset. Here he have to transfer the capital asset, whoever is paying the tax. Third one is transfer of a capital asset should take place during the previous year. Again, it is compulsory that whatever you are transferring, it should be transferred in the previous year and not in the current year or in the assessment year. Fourth one is there should be a gain or a loss on the account of such a transfer of the capital asset. So, these are some conditions which we have to remember while calculating the capital gain. Then is capital asset which is given under section 2 clause 14. You have to remember the section again. The capital asset means the property of any kind held by the assessee. Any kind of the property the assessee is having, whether it is connected to the business or the profession, it is not matter here. Okay. So it will be considered as a capital asset. If I am having some property in a kind, that will be treated as a capital asset. Second one is any security held by a foreign institutional investor, but the capital does not exclude the first one is stock in trade and second one is movable personal property used by the assessee or his dependent family member for a personal purpose, but exclude the jewelry, drawings, painting or any work of the art. And third one is rural agriculture land in India. And fourth one will be the gold deposit bond 1999 or a deposit certificate issued under the gold monetization scheme 2015 will be not considered here, will be excluded. Some important points here which you have to remember is the asset used for the personal purpose of the assessee, that is TV, car, mobile, etc. not a capital asset. CG not applicable. Jewelry, drawings, painting, capital asset. Capital CG means the capital gain is applicable. Okay. Second one is gold utensils, silver bar, silver coins are held not to the consider as a personal effect. The capital gain applicable here. Third one is silver utensils held to the personal effect. No capital gain will be considered here. Fourth one is car used in a business treated as a capital asset. Okay. And the fifth point is jewelry means ornaments made of a gold, silver, platinum or any other precious metal or any alloy containing such a metal, precious stone, whether or not set in any furniture, utensils or other article. So this is all about the income from the house property and capital gain.